The following content is for informational purposes only. The views and opinions expressed by the hosts and guests are solely their own and do not necessarily reflect the views of Aliyah, its affiliates, or any organizations represented by the participants. Nothing discussed should be construed as financial, legal, or investment advice.
Welcome to Market Cap, where we feature firms and funds to explore the thinking that guides them, the patterns they observe, and other forces moving the markets. I'm your host, Stefano, Director of Institutional Services at Aliyah, and with me I have Joshua Lim, Co-Head of Markets, and Gaspar, Market Strategist, both at FalconX. FalconX is a digital asset prime broker providing execution, financing, and liquidity access across spot and derivative markets to institutions. It serves hedge funds, asset managers, and corporate clients, connecting them to global crypto venues with integrated trading and risk infrastructure. Gentlemen, welcome to the show. So great to have you with us again.
Thanks for having us.
Thanks for having us. Great to be here.
To start out, I always like to ask our guests to tell us a little bit about yourself, what you were doing before, especially, how that shaped your thinking, and how that led to your current role.
Yeah, I'll kick it off. I, like a lot of people in crypto today, came from traditional markets, traded equity derivatives at a bank, several banks, and then realized how much fun crypto can be. Started in a treasury management seat, actually, sort of running some of the operational stuff in the back of Circle. This was in 2014. And then I've also been at a number of large platform businesses. And over time, I guess the general trend has been the industry growing from a retail-focused industry to a much more institutional industry. So I was at Galaxy for a bit, and then at Genesis, started my own firm called Arbalos, which was acquired by FalconX, and it's kind of how I landed here. I've primarily been focused on derivatives, my career, option space, and that has become a lot more relevant over time as the industry's matured as well. So that's one thing that FalconX is known for being a swap dealer and also a large trading partner for many hedge funds in the space that want to access it via options.
Definitely options. I've definitely seen them become more prevalent in the space, so we'll definitely talk about that. Martin, you joined back in September. Can you tell us a little bit about what you were doing before that and how it led to joining FalconX?
Yeah, so I started my career in TradFi. I was doing fixed income research at Wells Fargo. And to me, crypto was just a more exciting market. It unlocks a lot of efficiencies, I think, especially with 24/7 DeFi. So that's what really attracted me to go full time in this space. And before FalconX, within crypto, I was doing research at a crypto exchange, and then worked for a few years at a liquid token fund. And so now it's great to be back, at a trading desk here and publishing insights to support our clients.
Absolutely. Let's talk a little bit more about that. FalconX at a very high level, to set the stage a little bit, to help us and our audience understand, how does a prime broker typically generate returns and manage their risks? And also, is that model for FalconX?
For sure. I think the term prime broker is borrowed from traditional markets, right? It's usually a business that services, asset managers and hedge funds that want to access an asset class. Generally, it's coupled with financing. So, you bring some amount of capital, you get some leverage, and then you get access to a broad range of markets and instruments. And at a lot of banks as well, you can think, the prime brokerage is really a gateway to access the bank's trading desks, right? So if you have assets at a prime at, let's say, like a Goldman or Morgan Stanley, you would also be able to trade bilaterally with the trading desks of those firms and other firms. And I think that's all of those analogs, are also applicable to FalconX. That's kind of the same set of services that we provide, except, instead of trading stocks or foreign exchange or commodities, you're trading crypto underliers with us. And then the market access is really to venues like Binance and OKX and Bybit, the sort of large exchange traded venues. And then your access to maybe like more esoteric OTC type activities is versus our principal trading businesses, which is what I oversee. And a lot of that activity, like I said before, is facing our derivatives swap dealer. Some of it's our spot business. We have a lot of electronic business lines as well, where people connect directly to our API or execute directly on our UI. Or it could be sort of engaging our firm in a number of different like partnership modes, including token market making. A lot of projects come to us for liquidity as they launch on exchanges or on DeFi dexes, things like that. So it's a pretty broad range of things, but we've sort of designed the firm to service what we think is the next generation of crypto demand. And I think even though a lot of us came from traditional markets and have that background and training, we are also, in a way, very crypto native. We're very we believe in the technology, and we think that it's worth investing in like frontier connectivity to new venues. Like for instance, in December, we spent a lot of time working with Lighter. Obviously, we did the same thing with Hyperliquid prior to that. But it's something that we see demand from our client base for, where new modes of trading crypto come up. It's something that we want to basically provide as a service provider to them.
Okay, so what I'm hearing, yes, it's very expansive, like wide, broad, but also very agile still. It must be hard to combine those two, staying on the bleeding edge of where the industry is moving, but also very important in this industry, I think. So far, you've mainly touched on the similarities between you and a typical prime broker. What would you say you deliberately do different that other brokers do pursue, and why do you break from that?
Yeah. Well, I would say if I compare our firm to traditional prime brokers, the vast difference is around our ability to stay current with changes in market structure. And that's a crypto specific thing, right? Like traditional asset classes are relatively static in terms of the venues that exist, how people connect to them, what assets universe is available to trade. There's only a handful of IPOs a year, right? So everyone kind of knows like what is available to trade in the market. In crypto, it's very different, right? So we have to stay at the forefront. Like we're to the chagrin of our compliance and legal teams, we're all constantly adding new tokens, to the roster of things that we trade. We're always adding new venues as well. That does require a lot of security vetting, compliance vetting, all that kind of stuff. It's hard to do, I think, at a larger firm, because, and I think this is why, even though we partner with many banks, but and they all want to do crypto in some form, it's very difficult for them to achieve the offering that we have, because one is they're making a lot of money in other asset classes, right? Frankly, and they don't want to jeopardize those income streams for a newer asset class like crypto. It's like a little innovator's dilemma type of situation. And yeah, for us, it's just easy. I mean, we're entirely focused on this asset class, and it's our only priority. And we feel like we know the client base very, very well, just having worked with them for 8+ years. We can basically offer immediately on demand, like exactly what people want to do in this asset class. And then compared to our competitors in crypto, I think we are a little bit unique. We're set up differently, right? We're very kind of, like you said, expansive. We try to touch every vertical, not because it's all profitable for the firm with high margins, but because I think our clients are asking for it. And so for like, give you an example, if a project comes to us and they want to get off the ground, let's say a new base layer, They're going to want to tap into our custody business so that we can hold those assets on behalf of their major investors, their cap table. They will want us to offer staking on that asset, so that when other buyers come in to buy that asset, they can hold it and stake it through us. They'll want to engage with our OTC trading businesses, so that we can provide liquidity on the token and even structure maybe derivative payouts on that underlying asset. And then they'll want to have us enable it through our electronic trading platforms. They'll want to have it enabled through our DMA platforms. So all kinds of things, right? And I think those are that's the main reason a lot of people work with us, is like we do have a pretty broad reach and a pretty broad set of products.
Absolutely. So what I'm taking from that is we're seeing consolidation and integration of the entire stack. People want to come to one service provider instead of like dealing with a whole host of different ones. That makes a lot of sense.
That's right.
Moving on a little bit to just from FalconX, but what you guys see in the markets. Martin, this might be a particularly interesting question for you, given your background as in research as well. I'm wondering, what do you guys spot what are you seeing in the market or in the data that you think many other people are missing right now?
Yeah, I think, one interesting thing right now is CME basis is still pretty low, I think, from where we were a few months ago. The basis for Bitcoin futures right now is around 5 to 6%. And when you compare that to, 10-year treasuries yielding around 4%, suggests to me that we're not going to see, ETF flows be driven by this basis trade as it was, at points last year. And so I think when we're looking at, the ETF activity this year, it's been mixed. Yesterday was really strong. It's not driven from this cohort, in my opinion, based on this data. So that to me, suggests it could be more spot driven. Maybe some DApp buying, or retail interest is picking up again. So I think that's a super interesting trend to monitor right now.
Got it. And then on the flip side, a question I like to ask is, what do you think is a commonly held view, but that you actually think is wrong, or maybe just incomplete, that could be more nuanced?
Yeah, I think it is the debate of, Bitcoin versus gold and commodities right now.
Mm,
There's a ton of parallels with Bitcoin being digital gold. Why isn't it performing as well? I think part of the reason was, we had some idiosyncratic drivers last quarter around 1010, and this narrative of Bitcoin OGs and whale selling. And I think it's sort of wrong to compare the two right now, where there's been so much geopolitical concerns and uncertainty around central bank policy in the last few months, where gold has it's on another level right now, where it's a more established asset. It also has massive tailwinds from central bank purchases, right? So they have the structural bid that Bitcoin doesn't have. I think it's a bit unfair to compare the two right now. Bitcoin seems well positioned just based on its own merits. But I think, for a lot of people, expressing concern one way or the other that, why isn't Bitcoin tracking gold as well? I think it's, not the comparison to make right now.
I follow. You brought up 1010. That's an interesting event, of course, for the industry. You think we're still reeling from that, if you will? And how long do you think it will take before the market has processed this?
I can speak to that. Yeah, I mean, I think the Binance, sort of complex that suffered like an enormous amount of liquidations and other kind of market movements in October. It really did put a damper on enthusiasm in the space, and I think a lot of the following 3 months after that event were, sort of the sort of ecosystem of firms in crypto trying to figure out the fallout, trying to rebalance positions. I think also maybe rethinking like allocations to various menus and how to restructure workflows and things like that. And I think, the headline numbers are basically something like 20 billion of liquidations on perpetual swap type of instruments. And then, that being, let's say, an order of magnitude, I think maybe the next largest day of liquidations on the tape prior was around the FTX events, and that was maybe like 1.5 billion in size, right? So magnitudes wise, just something that crypto hasn't seen before. And that's been true actually of all of 2025, right? The asset class has grown so big, $3-4 trillion that even though let's say the volatility of the asset class has come in, the actual dollar impact to firms in the space has never been larger than ever before. And we see that in our own volumes as well. It's like our activity with clients, even though it's a little bit more it's a little bit more institutional in nature, like not kind of like the Wild West, like retail type activities in the past, but it is much larger in scale, right? So that's the fact that we had this event in a market that we thought had matured, I think is concerning for a lot of people. And I think it's driven like a bit of a rotation to dealers like FalconX, who are regulated counterparties and have, what are more conventional policies regarding like margin management and liquidations, liquidation of positions. I think it's something that's like a pretty highly regulated area in traditional markets. And it's something that we also adhere to, like the policies that, or even the standard conventions that you would have under an ISDA with counterparties about how you issue margin calls and how you provide notice periods and things like that. And I think also there's been some additional rotation into venues like CME and IBIT being the ETF for Bitcoin and the options market around that. Those are instruments that are a little bit more predictable, right, in terms of how the exchanges treat your risk on those exchanges, how they calculate margin. There's a lot more transparency around that as well. So I think it's caused a lot of people to rethink like where they trade and how. And in terms of just price action, I think altcoins, right, have suffered disproportionately to end the year. I think it's a number of things. I don't think it's only about 1010. I think a lot of it is, this sort of broken social contract between investors and token issuers that has emerged in the last couple of months around these acquisitions that large corporate entities have made of development teams for token projects. And I think we've seen firms like Circle and Coinbase and Galaxy, the public companies, large public companies, basically take on teams. But it's great, obviously, for consumers and users of those applications. I think it's bad for token holders because the token holders are basically losing some potential value accretion to their token. And it's like if a whole executive team left a company, right? You're left with some shares of something that are less likely to produce value down the line. And it's something that we all signed up for, right? As like token holders, there is no explicit value accretion mechanism for most tokens in the space. They're explicitly designated as like completely outside of the cap structure of a company. But I think that's it's something that needs to change. I think that a lot of people are kind of realizing that if there's a hope that tokens can be long-term investable as an asset class, I think we have to kind of change some of those, like, the idea of governance in token space and investor protections and things like that. So yeah, this is generally the story of crypto. It's like constantly rediscovering things that traditional markets have known for decades.
That resonates. Yes, for sure, for sure. My takeaway from your second piece is also, it ties back to your earlier point as well. It's about a flight to safety, as they call it, right? 1010 happens, and these mergers and acquisitions happen. and it's makes people reconsider their strategies, their allocations, their risk exposures, etc. So, yeah, these are some very interesting patterns that are on in the market, and you already lightly touched on how that affects you guys and your decision making. Maybe we could talk a little bit more about that. So, like, from all these things happened, right? 1010, BTC underperforming relative to gold, etc. How does that inform the decisions that you guys make, like the positioning that you take? How does that inform relations with clients, etc.? You already alluded to it actually kind of being good for business for you guys, but do you guys also change your positioning or behavior or choices based on that?
Yeah, I'll touch on a couple points. Maybe Martin, you can add as well. But I would say we've we don't take, well, first of all, we don't take, directional market risk as a firm. That's not our business. I think we're here to service clients that do that for a living. And I think our goal is to basically just provide the right set of tools for people to express views. And in that vein, like, I think the tool set has shifted a lot towards options. And I think that's unsurprising, right? Like, if we think about a market where there's less predictability on linear instruments and your protections around margining them, then people are kind of looking for more limited loss expressions of risk, especially with altcoins, right? Because the sort of asymmetry between upside and downside of altcoins maybe makes it more difficult to hold just like unlimited downside positions now in these alts. And so it's better if you do have a fundamental thesis on something, and you do have clear price targets in mind. And this is something that, Martin and I have worked on in the last couple of weeks on different tokens, different ideas that clients are asking for. I think the best way to express that maybe is in different option formats where you know exactly what your risk reward profile looks like. It's less operational risk, and it's sort of more targeted and more precise in how you express that view. That's I think that's a general trend, that we're seeing post some of the events of last quarter.
Yeah, and I think part of it is just trying to figure out which tokens and names our clients are interested in and want coverage on post 1010. One clear driver has been really just a compression and leverage and sort of leverage looping strategies. We saw TVL decline in names like Aave and Pendle and a bunch of other lending names. And to your earlier question, how is this impact being digested? I look to FTX as a barometer of when the market could bottom. It took around 2 months post FTX for a lot of names to bottom out. So we're kind of coming up on that now. That was sort of late December, and just now in the new year, starting to see you know the market cap of Athena's USDE pick up again, which I think that's a great sign that some of this demand for yield is coming back. And so we're always trying to think, what could be interesting to flag to clients, and what could make a good trade for them.
Interesting. So I hear what you're saying. And it's interesting to note how, like, such impactful events, how long of a tail they have, right? Like, it takes so long for all the effects to play out. And that's, I think, something that people underappreciate. They just think of it as an acute stress event. And of course, it impacts the markets, but that it takes a while for it to unwind is very interesting to see. Um, so what I'm taking from what you were saying, what you were both saying, is maybe you don't necessarily so much change how you position in the market or anything like that, but it does maybe impact the interest that you see from your clients for specific products over others. Is that correct?
Yeah, I think that's right. I think the prioritization of like downside protection, safety, and all that kind of stuff that Martin mentioned is definitely, yeah, it does affect how we position our firm. Like we're offering maybe less risky of a product set, like I said, with the options and
Mhm.
things like that. But I think, yeah, largely we're just responding to like demands that our clients have with regards to how they invest in the space. Yeah,
Can you maybe touch more on that specific mix of clients, right? You've been in the
sure.
space for a couple of
Yeah,
years. How have
it's
you
definitely
seen
changed a
it
lot.
change?
Yeah. Yeah.
I
Go ahead.
Go ahead.
Sorry.
Yeah, no, I was just gonna say I can imagine. I imagine more interest from TradFi players moving into the space. How, maybe as a follow-up question, how are the interactions? Because you mentioned working with banks. How are the
Right.
interactions with those guys? That's something I think that a lot of crypto native people are curious about. Like, how much do they actually know about the space? How
Mm,
much education do they need? How, what's their risk for appetite, right? Probably a lot more conservative, but yeah, paint a picture for us.
sure. I think, yeah, it's shifted a lot in the last couple of years. To like after the events of last cycle, 22, 23, it's become so a lot of that cycle, obviously, a lot of firms started to come into crypto for the first time. And you had a lot of banks announcing, "Hey, we're launching crypto trading," and things like that. And then we also post what happened with FTX and the washout in the space and the just general credit contraction and everything else. I think a lot of people also left the space, right? So a lot of the firms that hey, made a big announcement or whatever, decided to size down. Maybe some of the HFT shops too are just like, hey, it's not really worth it to play in the space, pulled liquidity, things like that. And I think what was left was really like a cohort of people that were very committed to the space, and of course we were one of them. It was a bit lonely there for a while in the space, but yeah, ultimately we think that it's worth investing in the long term, right? Obviously, just the products and people that are coming in now are similar to what we saw last cycle, but clearly also similarly long term aligned with the space. Like they're thinking of crypto much more as like a fintech, payments, stablecoin, maybe like infrastructure around trading and speculation. The ability to sort of aggregate assets, different asset classes in a single platform is a main reason why people think there's room to innovate in crypto. The permissionlessness of it, permissionless, creation and interconnectivity, the composability of it, right? Like those are all main reasons now why people are investing and trading. And so I think that that's the main difference. Kind of the thesis is less about hey, we'll all make a ton of money when Bitcoin 10x's. And it's more just, hey, we kind of think this asset class is maturing. It is in fact, more mature in the sense that the returns are less convex, right? Like, Bitcoin's 2 trillion. It's not, it could 10x. It could 10x. Could have a maybe like another gold like move, right? But it's not going to do that in a year, like maybe Bitcoin has done in the past. It'll take, a long time in small increments. And I think you kind of see that with gold today, right? Gold is a much larger asset class and it has rallied a lot, but it does it in a very sort of like orderly way for the most part. And that's what we'll see in the asset class. It's just like mostly people viewing it as a macro proxy for Bitcoin, and then for everything else, viewing it as a sort of a like almost like a networking technology, right, to enable payments and sort of permissionless building across different applications that exist in fintech.
Definitely. It seems to me that curious about your take on this, but it sounds like this cohort of more conservative and TradFi players coming into the space are less interested in speculation on assets and tokens and more interested in the actual tech and building out their own solutions for services that they already provide or have, right?
Yeah, that's exactly right. It's less, yeah, it's less about, you know, token picking and all that kind of stuff, and more about yeah, more about the fundamental technology. I mean, you can kind of see it too. Like a lot of projects are raising now these days with explicitly saying like, "Hey, we're not going to launch a token." You know, this is a cash flowing business. This is a revenue generating business. It's an equity business.
Yeah,
And I think, yeah, like more and more VCs in the space are putting a premium on that type of long time horizon mentality.
interesting.
I would agree
Yes.
with Josh that a lot of traditional players, you know, they're very interested in the tokenization aspect. At the same time, I think they're trying to meet demand um, for the majors, for example, right? Like there's some banks that have started, you know, offering their own products. And I think a lot of their wealth platforms, you know, have begun to offer, you know, the Bitcoin ETFs, maybe ETH ETFs as well. So I think, you know, sort of cryptos is a rising tide that they're going to have to get involved with. And I think next year, you know, this year and next year, it's going to be really interesting because these platforms are beginning to suggest a, you know, 2 to 4% allocation in crypto. And so the big question is, you know, how is that going to flow into the space? Is it going to be, you know, dominated in the majors? Is it going to, you know, broaden out to altcoins? So I think that's going to be like a big mega trend to watch. I'm especially interested in, you know, how the crypto index products will evolve. Um, as you know, that could benefit some of the, you know, some of the blue chips who've already, you know, gotten big enough to qualify for some of these products. So yeah, I think it's going to be really interesting, and you know, a lot of our clients are trying to figure out, you know, how to potentially position for that.
Absolutely. That sounds also like a fundamental shift in the way that inflows take place, right? It sounds much more structural. Whereas before, we need to have some hype going on, or like the market could go up and down. There's a lot of talk about this ending of the 4-year cycle. Um, do you guys think that's related maybe? Because institutions operate from a more structural perspective?
Yeah, I mean, I think there are cycles in traditional markets, right? There are cycles that are driven by our elections and you know, sort of like leverage cycles in the just traditional the macro economy, I would say. So I think as crypto converges more into traditional markets, like you will see more of those effects to macro cycles. I think it'll be less about the idiosyncratic crypto related things, like the Bitcoin halving cycle, or you know, maybe like the leverage cycles within crypto companies themselves. I think before, because crypto was such an isolated, um, almost like its own micro environment within a larger macro picture, and flows were relatively uh, flows were limited through a very small set of channels, right? Because of, let's say, the difficulties in banking access and things like that. Now the regulatory environment's like opened up in a meaningful way. We're about to get this market structure bill. It's become much more integrated into parts of the real economy that probably will introduce some cyclicality there, but will remove some of the more idiosyncratic, like crypto uh, quirks. You know, like
Yeah.
the 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 for instance, the last cycle, like that should never happen, but a lot of VCs and sort of like the demand for returns from startups were driving like real capital allocation decisions across the crypto landscape, right? Like how aggressive underwriting standards were for lending and things like that. Like that was a very specific crypto phenomenon, not related to, maybe marginally related to the macro economy with respect to like VC risk appetite and stuff like that. But I think more likely than not going forward, because of how mature the asset class has gotten, it'll be more like the general trends in the broader economy. But yeah, I mean,
Thanks.
I do think, I do think that we are at that transition point now, and that's why we're having all of these different growing pains with respect to like altcoin governance and things like that. But it'll be over time, we'll just look a lot more like traditional markets, with all of the annoyances of them, like the regulatory and all that kind of stuff, but also the the maturity and the liquidity of major asset classes.
I think
Exciting
distribution has
times.
been the biggest change in the last year, where now you have the ETF vehicles, you have a lot of fintechs offering crypto trading as well. So versus last cycle, most people have a lot more access to crypto. So I think the question then turns to where is the marginal demand going to come from? And my guess it is from people who don't have allocations, starting to pick up a few percent of their portfolio in crypto.
I think
We-
sovereigns too, right? Like maybe that's still an area of growth. I think when we started this administration, a lot of folks were anticipating a real buildup of strategic Bitcoin reserve. And there has been some movement in that direction, although a lot of it's just retaining assets that have already been seized. So I think, that specifically domestically in the US, but also just looking at the movements abroad, in the Middle East, in other parts of the world that are looking for perhaps like non-sovereign store of value, that rotation away from fiat reserves. I think that's kind of interesting. Like we've seen that happening in gold certainly, and notably being absent in Bitcoin, and resulting in a bigger divergence between those two generally correlated narratives between Bitcoin and gold. I think that's probably going to change at some point, but we just don't know when.
Interesting to cover these different potential trends that might be happening in the near future. The conversation kind of naturally shifted to this forward-looking orientation, right? When it comes to FalconX specifically, what's on the horizon for you guys for the next, let's say, 6 to 12 months?
From a business perspective, I think we are probably going to evolve our firm more in the direction of stronger, more less cyclical businesses that are more robust in terms of revenue stability. I think the idea here is like there are interesting business lines that we should kind of cultivate internally around custody and lending and things that have generally like recurring types of revenues. That's a big focus for us this year. The company itself is sort of like grown a lot over the years, and we can sort of decide which areas of the firm to invest in that are kind of like more robust in terms of like risk reward profile. And I think that's thematically probably true across the whole industry, right? A lot of firms are basically converging on the same type of structure across multiple business lines. You have like custody firms becoming more like trading firms, and you have trading firms add new product lines like options and market making, and also adding custody, So yeah, I think that's just a natural outcome of the regulatory environment becoming a little bit easier and people having more clarity on what they can and can't do. But yeah, I think that's generally the trend. Obviously, a lot of firms are looking at public market liquidity. That's, accelerated by the DAT trend earlier this year or in 2025. I think that's opened up the door for conversations around, what are our options in terms of raising debt or equity capital from public markets. At the same time, it's the competition for capital has never been more intense because of the voracious need for new capital for data center build outs and everything related to AI. If you look at the private credit trends, it's certainly not investing in crypto basis trade or financing trading firms in crypto or anything like that. It's going into AI, right? Basically, like the Mag 7 type of names as well. So it is harder, I think, for crypto to compete in that larger environment, but it really also depends on like the way that we evolve our product set as an industry. Like if it becomes if it's more in the direction of like universal access to financial services and things like that, I think that's like a lot more investable than buying and selling altcoins or meme coins or whatever, right? So that's yeah.
Absolutely. You made me remember something you mentioned at the start of the conversation as well, which is that all these firms are consolidating and integrating their services, right? The custody providers are integrating trading and vice versa. And I think that just speaks to the final point that you made, which is basically market maturation, right? It's an exciting time, I think, for the industry if you're willing to be professional and forward looking and to stick it out. But the market is definitely changing. So it must be especially exciting time for you guys, I think, and the way you guys position. Where can
Definitely.
listeners find you guys, contact you if they want, or just follow your work?
Sure. Yeah, I think the easiest way to keep in touch with FalconX as a firm is on Twitter. I believe our handle is at FalconX Global, and my personal Twitter is Joshua_J_Lim. And Martin, do you have anything else? Any other sources to keep in
Yeah, I
touch?
would add for FalconX website, falconx.io,
Yep.
and listeners can find our insights page there where we post a ton of market commentary.
Yeah, get it while it's
Amazing.
non-paywalled. It's publicly available. Our market comments, yeah. And also, I think if you obviously open for DMs and things like that as well, but yeah, we obviously would love to talk to anyone in the market that's sort of investing or trading and looking to access markets via some of our products.
Yeah, I definitely recommend people to do that. We co-published a report with you guys just last week as well on Pendle. So we're obviously very excited to be working with you guys. So I can't recommend you guys enough. Thank you for the conversation, for the insights. It was very interesting. It was quite forward looking, and can't wait to have you guys back on later this year or in the new year. Who knows?
Yeah,
Sounds
thank
good.
you.
Thanks for having us.
Definitely. All right. Also, we thank everyone watching and listening. If you enjoyed this episode, you can find more of our research in the following ways. For in-depth reports, many publicly accessible, join our research platform. For protocol and market summaries and highlights, subscribe to our newsletter. And for our next episode, follow us on X and YouTube. All links in our bio. This was Market Cap, where we feature firms and funds to explore the thinking that guides them, the patterns they observe, and other forces moving the markets. See you on the next Market Cap.